If I look at the halftime report, the S&P 500 is rocking it out. It's up 17%. Investment-grade bonds, high-yield bonds, all pretty good runs, nearly double-digit. What needs to happen to continue that kind of rally, or can we continue that kind of rally just on a trade truce alone?
Well, we think risk assets can push higher, but wouldn't necessarily be on the back of trade truce alone, in that now that we have G20 out of the way, where we also had largely as expected outcome versus expectation kind of going into G20. Now focus goes from trade towards fundamentals and also towards central banks. And fundamentals are still reasonably okay. Growth is slowing but still growing, and central banks have taken a distinct dovish pivot, and the latter two are supportive of risk sentiment, which is why we think that risk assets can push higher now that G20 is out of the way.
You think risk assets can push higher with G20 out of the way. What about in terms of fixed income? I think the last time we spoke, you were seeing some decent inflows into fixed income. Do you expect that to continue through the rest of the year as well?
Yes, we do. And that, in part, is also because of the structural change in fixed income. Specifically, the flows that we're talking about is fixed income ETF flows. And penetration rate for fixed income ETF is still very low versus the underlying market, which is less than 1%. So the structural adoption of ETF in fixed income should see greater demand for fixed income going forward. But more broadly, in the context of markets, we have seen a lot of inflows into fixed income so far versus equity versus commodity, almost disproportionately so. And so far, this risk asset rally has been less participated in that there isn't a lot of inflows into equities. So maybe going forward, as sentiment becomes a bit more robust, we could see a bit balanced picture in terms of flow into fixed income, equities across the board.
This is one of the debates Naren and myself have with a number of guests. We talk about flow. So I've noted some of them down for 2019, Wei Li, and this is where I think maybe the second half could be driven by FOMO, fear of missing out. In the US, $41 billion flowed out. Globally, $138 billion flowed out of equities, and in Europe, $71 billion. So it's not exactly a loved-up rally. It's not a fully engaged rally, is it, by the investment community?
We see similar pictures in the ETF space as well. And if you look at investor sentiment survey, there's still a lot of cash on the sideline. And now as sentiment becomes a bit more positive, and the fact that this rally has not been participated in as much as one would like to your point, FOMO could be one of the catalysts driving flows higher. But fundamentals too is another reason behind our rather constructive view in terms of flow for the remainder of the year, in that we do see risk assets pushing higher, and investors will want to participate ahead of summer before the quieter times, less liquidity periods. They would like to allocate ahead of that.
It's interesting because earlier Manus was saying, you know, the Trump put's been put into action. We can see that clearly today in terms of risk assets rallying, the havens pulling back a little, attention turning to the Fed put. And interestingly, the pricing hasn't actually changed that much in terms of bond markets expectations for Fed rate cuts. They're still expecting something like 4 rate cuts by the end of next year. July is still fully priced in. What does all that mean for gold, Wei Li? Because, of course, that has been acting as the safe haven on geopolitical risk, but then also it's been gaining because of those expectations around the Fed. We've got a significant pullback today, biggest drop in a year. Are you expecting large inflows into gold to continue?
Well, we have seen large inflows into gold alongside price pushing higher in the last few weeks or so, with rates pushing lower. We do see a demand for gold, a case to be made that a diversified portfolio should have gold as part of that. But to see price levels pushing higher, we need to see risk sentiment to be a bit more negative, and we also need to see real rates pushing lower, which is unlikely given where things are at the moment. So gold may not push from strength to strength, but we still argue for a place for gold in your portfolio.